Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, this is Richard Bernoulli with the FRA. Welcome to the Roundtable Insight. Today on the program, we have John Butler and Alasdair Macleod. John is the Vice President and Head of Wealth Services for Goldmoney, the world's leading provider of savings, payments, and other financial services, all fully backed by physical allocated gold. Prior to joining Goldmoney, he had a 15-year career as a macro investment strategist at Deutsche Bank and Lehman Brothers, among other firms. He is also the author of The Golden Revolution, a book analyzing the causes and consequences of the 2008 financial crisis and exploring ways in which gold could re-enter the international monetary system. And Alasdair is head of research for Goldmoney and an Austrian economist. He has a background as a stockbroker, banker, and fund manager. Welcome, John and Alasdair.
My pleasure.
John, recently you had an insights piece on Goldmoney in which you discussed causes, symptoms of the financial market consequences, and potential for stagflation. So just wondering about your thoughts on that. Do you see an inflection point now in terms of rising inflation?
Well, very much so, Richard. I mean, theory would have told you years ago that all of the money printing that took place during and subsequent to the financial crisis of 2008 would eventually turn into a rising price level. There tends, of course, to be a relationship, albeit a very, very unstable one, between expansion of the money supply on the one hand and the rising nominal price level on the other. Now, that said, it can't be modeled precisely, which is why the bulk of the economics profession doesn't bother to even think about it. That is, just because we know qualitatively and theoretically that there is clear cause and effect here, the fact that it can't be modeled precisely in a quantitative sense means that the economic mainstream hire concept because they find it inconvenient. But the reality is that indeed, these things do happen in that way, and we are now finally seeing it, right? We're finally starting to see what I would call smoking gun evidence that the vast expansion of the money supply in all major economies that took place in 2008, 2009, and indeed through 2013 in most cases, and even longer in the case of Japan, that yes, that is finally following through now into a general consumer price inflation. And we're seeing it in commodities, which have bottomed even in dollar terms, and the dollar is strong. In any other currency, commodity prices bottomed over a year ago. That's number one. Number two, you're seeing it in wages. And even in Japan, I mean, this is astonishing, right? Even in Japan, which has been mired in deflation forever, wages are picking up. And they're picking up very rapidly in some economies, but even in the ones that are, were considered to be deepest in the deflation, you're seeing wages picking up. And any mainstream economist will have to acknowledge that the wage component of consumer price inflation is massive, right? It's massive. And once that starts to trend higher, then it's trending higher, basically, is what it comes down to. So yes, we have passed an inflection point. That said, we've passed it with growth generally weak in most economies around the world. And so this combination of inflation, that is consumer price inflation, now clearly rising on the one hand, and yet growth weak or even slowing further on the other, that is a stagflationary mix. And that is a just potentially horrific environment for investors because it implies a potential underperformance of both stocks and bonds.
And do you think this phenomenon, this beginning of rising inflation would be exacerbated by the talk of and the follow-up through by helicopter money printing by central banks in terms of fiscal stimulus spending, for example, on infrastructure? Would that accelerate the inflation?
Well, this is where the monetary doves are really showing their feathers, and where the fiscal profligates are really showing just how spendthrift they are. The fact that they're still talking about this, in fact, talking about it even more aggressively now than they have been for a while, notwithstanding the clear evidence that the inflection point is behind us, it kind of tells you everything you need to know. They simply want to inflate their way out of the massive debts that they have created for their own political expediency reasons. That is the world we're now living in. They're making it very clear. They're not being cagey about this. It's amazing in a way how openly they are discussing so-called helicopter money. They almost use the term as if they're wearing a badge of honor, as if they have the courage to fly helicopters, to paraphrase Ben Bernanke. It really tells you just how, for lack of a better word, just how insane they have become.
Alasdair?
Yeah, no, I would agree with that. There's something else I think we can add to this, and that is there is an assumption amongst the Keynesians and monetarists that if the state expands the quantity of money in circulation, it will stimulate the economy. As a one-off, that is certainly possible, and it works on the basis that it fools people into thinking that there is real extra demand in the economy. Obviously, there's not, because if you like, the payment for that extra money actually is a tax on all the existing money in circulation. That gets realized not immediately, but gradually over time, so that you find that prices start rising where that new money is spent first, and then gradually the price rises ripple out from that point. And this is why, if you go to financial centers like London or New York or Zurich or wherever, you find that prices are considerably higher in the center of those cities than they are in the surrounding neighborhoods. And in the surrounding neighborhoods, the prices are considerably higher than they are deeper in the country. But what this means is that there is a gradual wealth transfer because the purchasing power of an individual's wages and savings, particularly if that individual is on a fixed income, is basically being debased by price rises which are emanating as a result of this extra money being injected into the economy. So what you're doing, in effect, is you're making a few people more wealthy by printing money and giving it to them first. They get the first dibs on it, as it were. But you are making the vast majority of people impoverished. Now, as a matter of monetary policy, to do this continually, all the time, and certainly on an accelerated basis from the Lehman crisis, guarantees that there is no economic recovery at all in the economies which suffer from this excess money printing. That is basically what is happening, and that is the other end, if you like, of the understanding that we really do have over the problem of stagflation. Stagflation is essentially just one thing, and that is the early stages of a price inflation which risks morphing into a hyperinflation. Now, last time this happened was in the 1970s, and in the case of America, Paul Volcker managed to stop that by raising interest rates to a level which basically forced people to stop spending and increase their preferences towards holding money and gaining interest on that money. And it took a rate of over 20% on the Fed funds rate to do it. We have a situation today where there is so much debt around that it is impossible to conceive of a situation where the central banks could raise interest rates to a level to slow down, to control, if you like, the switch in preference from away from money and into goods, which is basically the source of price inflation. So therefore, we then have the situation where, because there is so much debt, it's going to take very little in the way of a rise of interest rates in order to stop price inflation. Now, the central banks are actually aware of this, or if they're not aware of it, they will become aware of it very shortly, because they will be forced to raise interest rates behind the curve as price inflation starts accelerating next year. Now, why is it going to accelerate next year? It'll accelerate for the very simple reason that producer prices started rising strongly this year, really from about a year ago. I think the turning point was probably the middle of 2015, at which point the producer prices index had been falling quite sharply, and we have a turnaround from negative to positive, which is going to guarantee a high rate of inflation, or a higher rate of inflation in 2017. Now, the point is that the interest rate response from the central banks is going to be insufficient to control it, for the very simple reason, as John just said, basically they want to devalue debts. They don't want to increase the real value of those debts with like a 2, 3 Fed funds rate. I mean, suddenly the whole thing will look very, very dangerous. Not only that, but the price of bonds would fall, which again would threaten the liquidity of the banks who have loaded their balance sheets up with government debt, particularly in the Eurozone. So you can see that there is likely to be a huge reluctance on the part of central banks to tackle inflation. So that is the other way of looking at the point that John was making.
Yes, and an important factor is the real rate of inflation taken from subtracting the inflation rate from the nominal interest rate. As long as that remains negative or increasingly goes negative, it still represents an environment similar to today with negative nominal interest rates.
Yes, absolutely. And the other point about this is that the CPI deliberately understates the increase in the general level of prices in the economy, through things like hedonics and all the rest of it. If you had a true representation of the increase of the general price level in the US economy since the Lehman crisis, I think you would find that as a deflator on GDP, we will be showing negative growth every year since the Lehman crisis. And this is the other aspect, if you like, of the proof that everybody is getting poorer through the wealth transfer effect, which results from the printing of money and credit.
John, do you think that if there is not a political will sufficient to bring about helicopter money printing for fiscal stimulus on infrastructure, if that were not to happen, would this trend still happen in terms of rising inflation?
Well, that's kind of what I do believe. I think that this inflection point and the trend now towards rising consumer prices, it's kind of baked in the cake. That is, it's the legacy, the effect of all the stimulus we have seen to date. It's not a function of any helicopters, firing up their engines. Of course, that would exacerbate it. And as Alasdair has said, this transition, which could occur from stagflation, which is bad enough, to hyperinflation, which is disastrous. The helicopters might be absolutely, the key element to moving from one rising trend of consumer prices and squeezing incomes and everything that Alasdair has been talking about. That's baked in the cake. That's happening already. And the lags were long. They took years to come through, but they are coming through, and they'll continue to come through. And they'll probably come through for several years, almost regardless of what central banks do in the near term now, because that's the way the leads and lags work in these things. So God forbid they actually do now fire up the helicopters and throw even more stimulus around. You're going to add fuel to the inflationary fire. Helicopters, of course, is a great metaphor in a way. Milton Friedman chose them for good reason, and he's famous for having done so. Keep in mind, one of the most famous films to come out of the same era when Milton Friedman was talking about helicopter money as a concept was the film about the Vietnam War, Apocalypse Now, in which the helicopter features very prominently as a weapon of war. And there's a famous line in that film, of course, following the complete destruction of a village, which gets napalmed, when Colonel Kilgore says, "I love the smell of napalm in the morning." I hate to say this, but the central bankers, it's almost as if they have the same mentality. They love the smell of inflation in the morning. They just have this obsession with it, even though it's destroying, the middle class purchasing power.
Yeah, and Alasdair, your thoughts?
Yeah, no, I would agree with that entirely. I think another way in which I can perhaps draw your listeners' attention to the dangers of this inflationary scene is to look at the case of the United Kingdom. Since Brexit, obviously sterling has weakened, and it's weakened very, very substantially. It's fallen from about 148 or something on the eve of the vote in June, and it's currently around about 121, 122 to the dollar, this is. Now, if you look at what's happened to producer prices, which I was talking about earlier in the US case, for sterling, what's happened is that falls in producer prices of about 20% annualized as recently as the middle of 2015 have now reversed because of higher commodity prices and also because of lower sterling. It's reversed from minus 20 to plus 25%. That is the current rate of PPI inflation in sterling. Now, imagine what that is going to do to the inflation rate here in this country in 2017. I don't know how much it's going to work through, but one thing that will happen certainly is that companies' margins will be squeezed very, very badly, so that UK business will go into recession, unemployment will rise. Yet at the same time, we're likely to have a headline rate of inflation, even with the suppressed CPI numbers, in excess of 5%. Now, if someone told me, sort of ex ante, that actually what it turned out to be was something like 8%, I would not be surprised. But let's just go with 5%. Now, this has come about because, and to bring up John's point, Mark Carney, the head of the governor of the Bank of England, decided in his wisdom, amongst other things, after the vote, to ease monetary policy. He announced a cut in interest rates and a new round of quantitative easing or bond purchases. And I mean, this is just complete lunacy. I mean, surely anyone who's got any sense waits and sees the effect of Brexit. And I can tell you the immediate effect of Brexit was there was a little bit of a pause here and there because things were put on hold because there was a bit of uncertainty. But guess what? Very quickly, this economy started taking off again. We are growing actually quite rapidly. And there's no good the governor of the Bank of England turning around and saying, oh, there's trouble ahead, so we better cut interest rates. I mean, quite honestly, it shows exactly what John was saying, that they've got this sort of whiff of napalm and they just cannot get it out of their nostrils.
And in terms of the effects of all of this on equities, property prices, you recently mentioned, Alasdair, on the breakdown on the traditional relationships between stocks and bonds appears to be breaking down, and a rise in bond yields, interest rates, would also threaten equity and property prices. Can you elaborate on that?
Well, at the moment, the bond markets are controlled by the central banks. It's actually as simple as that. And they will continue to control it for the very simple reason they cannot afford for there to be a bear market in bonds, for the reasons we've already gone over. But at some stage, and this always happens, the market predominates, the market wins, the market takes over. Now, when that happens, you're going to get a very substantial rise in bond yields, and you will also get a very substantial fall in equity prices. Now, in the UK, we have routinely 80% loan to value mortgages. So the residential housing market is likely to take the most enormous hit from a stagflation development in 2017. So all the assets which have been puffed up and sustained since the initial recovery from the Lehman crisis basically are at risk. And it's not just in this country. It's very, very marked in this country, but it is also true in the States, and it is particularly true in Europe and in the Eurozone, where the whole thing is basically on life support and completely dependent on the market being rigged by the ECB. When that market rigging starts cracking, then I think we just have to watch out. It could be extremely uncomfortable and very, very expensive for anyone who is invested in conventional assets.
And for alternative assets such as gold, John, would the rising inflation trend, how would that affect gold prices? Like, would it necessarily be bullish, or how do you see that affecting gold?
Well, because gold is a real asset and it's a liquid real asset that cannot, possibly default. It's gold. It's a rock. Gold prices do tend to rise with inflation, but more importantly, in this context, is stagflation. Stagflation is an even better environment for gold, and the reason why is that if you're in what you might call a relatively benign inflation, where at least growth is still very healthy, then of course, equity valuations can continue to rise, and one can even do much better out of equity investments than they can out of just sitting in gold, which is relatively it's completely risk-free, but relatively less risky than equities, and of course pays no actual yield, unlike equities that pay dividends. But you get into stagflation, which is just horrific for corporate profit margins, and therefore corporate profits, and therefore corporate valuations. And equities, don't get me wrong, I mean, prices might have still managed to rise in a stagflationary environment because of the underlying inflation taking place. But gold will outshine equities dramatically. That was the case in the 70s. Major equity indices went basically sideways in the 70s, notwithstanding the stagflation, whereas gold just went up and up and up. It is the best environment for gold outright in price terms, and it is the best environment for gold relative to that for financial assets, both stocks and bonds. I mean, Alasdair has already explained why bonds get crushed in stagflation, but also why equities don't do as well as they otherwise would because of all the profit margin issues. And so that's really, look, stagflation is unusual. It doesn't occur in every economic cycle. It only occurs in, the occasional cycle, and in those cycles, which tend to be those that follow major financial crises, when policymakers throw loads of stimulus, physical and monetary at the problem. But here we are. This is the best environment for gold, both outright and in relative terms. So don't get me wrong, never put all your eggs in one basket, but you cannot, as an investor, responsibly create a portfolio for a stagflationary environment that does not have a material allocation to gold in it. You just can't do it.
And Alasdair, your thoughts?
Yeah, I'd like to add, John said that over the course of the 70s, stocks were sort of stable. I mean, obviously they moved very substantially in between, within an overall stable pattern. But it is interesting to look at the UK's experience. In those days, we had something called the FT30 index, which really was almost like a clone of the Dow 30. And that peaked, I think, from memory, in May 1972 at about 535. It then bottomed out in the first days of 1975, believe it or not, at 140. This was a very substantial fall. I think it was around about 70% collapse in equities. From that point, it then went considerably better, and we ended the decade, I think, sort of more or less unchanged. Maybe hadn't quite made it all up. But the point behind this is that when you get inflation, which was the real problem in the early 70s, it was the emerging problem, it was the early stage of the inflation problem, then you do get markets being destabilized, conventional markets being destabilized. The social ramifications are extremely unsettling. We had labor strikes all the time, and we even had things like what's become infamous as the 3-day week. In other words, the electricity would be turned off for 2 or 3 days in the working week because they weren't delivering coal to the power stations, and so on and so on. So we mustn't look at this stagflation scenario just in the very narrow terms of the financial effects. There are also social effects, and it is the interplay of the social effects and the financial effects that make it considerably worse for conventional assets. And I think that point must be understood.
And in terms of this rising inflation trend, how do you see that trend being affected by current key big issues, for example, the outcome of the U.S. presidential election, what's happening at Deutsche Bank in terms of their derivative challenges, what's happening in Italy with an emerging banking crisis there on non-performing loans and other challenges in the Italian banking system. John?
We need to understand just how distressed the European banking system is. It never materially recapitalized, deleveraged anything post 2008 at all. It just didn't. And yes, there's been some rhetoric to the contrary. That's basically propaganda coming from regulators, central bankers, etc. I mean, any objective look at the balance sheet numbers shows you that has not happened. Now, there have been all kinds of accounting shenanigans deliberately engaging in some structured transactions whose only purpose is to disguise the fact that they are undercapitalized vis-a-vis regulatory requirements. But sadly, it's even now sort of emerging that even the biggest banks in Europe, such as UniCredit and Deutsche, they sadly have also been, look, whether they're deliberately falsifying things or whether they just don't understand some of the structures that they've entered into, is difficult to prove without going through a very, very, very elaborate process. But sadly, one way or the other, there is almost overwhelming, if still circumstantial evidence that even some very large banks in Europe are in even worse shape than they were in 2008. I mean, that's kind of what's coming out now. And if you look at the valuations of their shares, if you look at the spreads on their subordinated debt, and even their senior debt in some cases, the market's kind of telling you that they have figured this out, that they've smelled enough stuff that stinks to draw certain conclusions. The problem is this: is that the world is globalized, and while on the one hand, international trade is wonderful, and it's great that goods move across borders and finance moves across borders, and that people can move across borders. I'm a huge fan of free movement of goods, services, and people who are willing to work. That's all great. But the dark side is that if you allow a financial system to over-leverage and whatnot, and not capitalize itself properly, then you have these cross-border linkages. And what happens in Italy spills over into Germany, spills over into the UK, spills over into the US, Japan, so on and so forth. If it happened in the 1920s and 30s, and it did, even then, the fact is the massive banking crisis that really catalyzed the early 30s Great Depression was the failure of the Austrian bank Kreditanstalt. Look, if it could happen then, that an Austrian bank could catalyze a cascade of solvency issues and defaults across the entire world, my God, it can happen today. And I'm just amazed that more people are not, sort of connecting the dots, as it were, and applying basic logic.
Mm-hmm. And Alasdair, I'll give you the last word.
Okay, well, I can certainly add to that. I agree with everything John has said, but I think it's even slightly worse than he's letting on. If you look at the Italian situation, Italian non-performing loans, which are all in the private sector, are officially admitted at 40% of private sector GDP. I mean, just think about that for a moment. This is a horrendous number. It gives you a very clear indication of the underlying state of the Italian economy and why it is that almost 50% of youth are unemployed in Italy. This is staggering. And there is absolutely no way that Italy can get out of this problem without actually facing the Grim Reaper, if I can put it that way. That's the first point I'd like to make. It's not just the banks. The banks are the messenger. The banks will go under, and we will all notice that, but the underlying situation is impossible as well. The other thing I would like to say, this is something that came up on Zero Hedge tonight, which I found very interesting, and that is that Deutsche Bank's ETF division is suffering withdrawals at the moment, and the withdrawals are estimated to be worth around about $8 billion equivalent. Now, this is about, I understand, it's about 10% of their ETF, of the ETFs that they originate and run. Now, the problem here is that almost all the ETFs that Deutsche Bank have initiated and run are synthetic ETFs. And by that, I mean they get their exposure to, let's say, the DAX index or the S&P or whatever through futures and options, but the underlying assets of these ETFs are invested in bonds. And guess what? These bonds are almost always provided by Deutsche Bank itself, and by definition are the bonds that Deutsche Bank's other desks don't want. So you have liquidity issues here. You have maybe mark-to-market problems here, which could lead to a systemic problem in the ETF market. I'm just giving an early warning. I hope this doesn't happen. Believe you me, I really do hope this doesn't happen. But I'm just seeing something that is just ringing an alarm bell in the back of my mind. I just hope that alarm bell doesn't get any louder.
Wow, that's unbelievable. We live in fascinating, interesting times. It'll be interesting to see how this plays out. Gentlemen, just wondering, how can our listeners learn more about your work? John?
Well, as you've explained, both myself and Alasdair work for Goldmoney, the world's largest independent gold custodian and provider of a range of financial services fully backed by physical allocated gold. We do maintain a website full of research and education firm does and the services it provides at goldmoney.com. We would certainly welcome for anyone to visit that and to go to the research pages. And in fact, we have quite a large group of researchers. In fact, in terms of quality and headcounts, you could argue that we have the strongest gold and real asset and alternative economic research team of any major financial institution in the world. I'm quite confident making that claim. And I would suspect Alasdair will back me up there. So yes, we
as part of it, John, I quite agree.
Yeah, yes, exactly. So I'm not surprised that Alasdair's backing me up here, but yes, we would strongly encourage anyone who has been remotely interested in what we've had to say this evening, at recording time that is, this evening, to visit that website. Alasdair, over to you.
Yeah, no, I don't think I've got anything to add to that. The only thing I would say is that when you go on the website, heading, and then you'll get another menu from there once the page moves on to the wealth section, where you can look at the various categories of research that we produce. So that's where the basic information is.
Great. Thank you very much, gentlemen. And that's it for today. Thank you very much.
Our pleasure.
Take care.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.